In the previous lessons in this chapter, we reviewed some of the general principles of property taxation. In this lesson, we will review property taxes specifically for the state of Georgia. Georgia's property taxes are ad valorem. That means they are based on the value of the property. The state taxes all property, including personal property, unless otherwise exempt under law. Real property is real estate, including the land as well as anything on the land, grown on the land, or otherwise affixed to it. The state defines personal property as anything else a person owns. Taxes are county-based. It's taxable by the county in which the property sits. Each property owner receives a bill on January 1st of the year. Returns are due to be paid by April 1st each year. This is done through the county's tax commissioner's office or the county tax assessor's office. In Georgia, if a person fails to pay his or her taxes on real property, it may be levied on the property, and then the county can force the sale of the property. Also, important is the use of the property. In Georgia, the funds collected from property taxes are used to pay for support services at the local and state government level. How Georgia assesses property value. Who determines the value? Georgia's property assessment process aims to have all real property taxes at the value by which the property would be sold at cash value. This does not apply to property sold through an auction or other type of forced sale. It's required to be assessed at 40% of that value. The Board of Tax Assessors handles the assessments, which are then approved by the State Revenue Commissioner. This organization's goal is to ensure that property values are fairly assessed across the state. If the property owner doesn't feel the assessed value is appropriate for any reason, he or she has the right to appeal the decision. In Georgia, this can be a bit of a long process, but it is all handled by the County Board of Equalization. There are some types of property that have specific considerations. If a buyer purchases a historic property or rehabilitated historic property, for example, which is somewhat common in the state, the assessment is a bit different. For historic property that meets the requirements of the Georgia or National Register of Historic Places, a preferential assessment is done on the structure. The assessment is set for 9 years, during which time it doesn't change. Many people purchase rehabbed historic properties. In this case, a preferential assessment is possible if the property's rehabilitation has increased the market value of the structure by at least 50%. If it is an income-producing company, the value has increased at least 100%, or the property is residential but partially income-producing. Let's say there is a property that is in a historic district that is purchased, rehabilitated to its former glory, and then opened as a walk-through museum. As long as the work done increases the value by 100% in this case, a preferential assessment occurs. And that means the value is locked in for 9 years. That's usually a significant money saver for the organization. Landmark historic property is yet another potential preferential assessment. This can occur when the property is certified at the local government level to be of landmark value. For example, it could be a century-old home the city deems is valuable for the history of the community. It also must meet conditions of local ordinances that extend to preferential assessments. There are other special assessment programs available as well. This includes agricultural property, conservation use property, environmentally sensitive property, and forest land property. Others include brownfield property and residential transitional property, or property that's being developed into residential property. In each of these cases, the assessment value is based on specific terms. For example, in an environmentally sensitive property, the assessment is based on the current value of the property, not the fair market value, when the property is maintained, improved, and meets the goals of the Department of Natural Resources. Consider farmland. For preferential agricultural property, which is readily sold often in Georgia, there is a different taxing process. If the agricultural property is determined to be a bona fide property, such as a working farm, it can be assessed at 75% of the typical assessment of a property. For example, as noted, residential real estate is assessed at 40% of the fair market value, or the amount someone would pay if they bought the property on the open market. Farmland that fits this qualification is assessed at just 30% of the fair market value, or 75% of 40%. Other types of assessments are based on the land use as well. For example, timber is not taxed until it is sold or harvested, and then the tax is based on 100% of the value of the timber at that time. Equipment, machinery, and fixtures are assessed at 40% of their fair market value, with several limitations and restrictions based on the original cost of the property, depreciation, and inflation. Considering all of that, how about the tax rate? The tax rate in Georgia is set each year by each county. Several organizations can establish the tax rate here. This includes the Board of County Commissioners, which handles most taxing. It can also be done by other governing authorities within the taxing jurisdiction. That can include local governments. The Board of Education also has the ability to set tax rates. The tax rate is fairly straightforward. A 1 mil tax rate is equal to $1 per $1,000 of assessed value. In Georgia, the average millage rate at the county and municipal level is 30 mils. This doesn't mean all locations have this, and it is very important to verify the mill rate of the property independently when you need this information. One change over the most recent years is the phasing out of the state mill rate on personal and real property, which has long been in place. Effective January 1st, 2016, there is no longer a state levy for property taxes. At the city level, municipalities are able to assess their own property taxes. This is done based on the county assessed value of the property. In other words, the county assessor sets the value of the property. Then, the city establishes its own law for the tax rate. The city then collects the rate at the value the county has set. Here's a quick example. Let's say the county commissioner determines the fair market value of a home is $100,000. At 40% of the fair market value, the assessed value is then $40,000. From there, the millage for that property is determined. Let's say the property is impacted by 25 mils. We will then divide the $40,000 by 1,000 and then multiply by 25. So the taxes paid are $1,000.